a snapshot of trends that we're seeing in 2013. What I'd like to do today is really start off with the big picture of what's happening in this country with single-family homes and real estate, because there's a couple of trends that we've talked about in 2012 that have really kicked themselves into high gear in 2013. Let me show you an article that just came out last week, and a lot of you may not even realize that this is happening, but this is from Bloomberg, and it's from January 9th. And what it talks about is Blackstone. Now, some of you may or may not know, Blackstone is a private equity group. And at the beginning of 2012, they raised $13.3 billion, that's billion with a B, dollars to buy single-family homes. Now, this is really unprecedented. There has never been a major fund capital raise on this scale like this in the last 50 years. One of the problems with buying single-family homes has always been how difficult it is to operate and manage them. So companies like ours have really been across the country, 50 to maybe 25 to 1,000 units under management has really been the limit of this. Blackstone and several other large private equity groups raised a total of initially in 2012 $35 to $40 billion to buy homes. We're talking 250,000 homes that they're looking to buy. Where are they buying these homes? Well, in the markets that really traditionally tend to go up and down, the kind of nonlinear markets. So think California, think Florida, think Las Vegas, Chicago, and then you have a whole secondary group of private equity group companies that have realized, wow, real estate's an incredible value, single-family homes are incredible value. Let's not go compete with the big boys. In fact, I think in the article, they do list the markets that Blackstone's buying in. Right here in this paragraph: Atlanta, Chicago, Vegas, Phoenix, Northern and Southern California, Miami, Orlando, and Tampa. Markets that lost 75 to 80% of their value in some neighborhoods. Now, you can also see in the very next paragraph, they talk about how Blackstone has been purchasing so many homes that they don't have the construction and the management to keep up with it. They call it warehousing. That just means they've been boarding them up. And what's significant about this article, this was a trend that we saw in 2012 and that we mentioned to a lot of you as something that was a big issue. In fact, I have a private equity group that I'm a partner with. I'm a general partner. And then and we're buying homes here in Indianapolis that we're holding on to. But even bigger is we're working with a group out of the Bay Area in San Francisco and buying homes for them here in Indy. They'd like to buy several hundred homes in 2013. So there's a lot of groups like 510 Capital that want to buy 200, 300, 400, 500 homes, and then there's companies like Blackstone, which is the largest, who want to buy 250,000 homes. And what's interesting about this article is that home prices are going up faster than Blackstone ever expected. Now, I personally saw this because I was buying homes in Las Vegas in 2011. Into the beginning of 2012, and there was homes that we could buy for $30,000, $40,000, $50,000 that in 2006 had sold for $350,000. By the end of 2012, those same homes that were selling for 30, 40, 50 were up to 80, 100, 120, and they've continued to jump like that. We've seen that in Florida, we've seen that in Phoenix, we've seen that in Vegas, we've seen that in California. So, if you're an investor that's thinking, well, why don't I just go where Blackstone is? I would say to you, good luck, because those guys, what they're willing to pay for properties is just ridiculous. You can't even make those properties cash flow again. I had an investor group that approached me yesterday and said, hey, we have a lot of demand for Florida properties. If you could buy, set up your operation on there and buy property, we would love to participate in that. And I laughed and said, good luck, good luck competing with private equity. Because if you think about what the rate of return they have to make is, they can be happy in Florida making 8% on a house, because they'll make that for 3 years, and then they'll turn around and sell it to a REIT. or a large publicly traded fund. So private equity is just a huge trend right now, and it's impacting every market in the country. For years and years here in Indianapolis, there was just a handful of local investors buying properties at foreclosure auction. It was the same faces every month. And I would say about 6 months ago, a couple of big funds have come in and they're buying a lot of property. Now, one of the good things about our model is we really kind of focus on buying working class and middle class homes. And these funds kind of want the upper middle class and higher end properties here in Indy. Now, when you think about the median home price being $100,000, these guys are buying properties between 80 to 120, 125. And those aren't properties that we've ever bought anyway. So they haven't really affected us because, you know, we like to buy 30s, 40, 50, $60,000 homes. And so they've really kind of stayed out of our backyard, and we've been fine with that. But, you know, I've talked to investors in Atlanta who, for years, had a business like mine, and they're like, we can't get inventory anymore. Private equity shows up at the auction and pays much, much more than what we ever would have paid. So this is a big trend, and it's affecting every aspect of real estate. Now, what does this mean to you as an individual investor? Well, what it should mean is that there really has never been a better time to buy investment property. Guys, the market has turned. If you were waiting for the bottom to start buying homes, it was, you know, beginning of 2012. In fact, here's an article from November from Reuters that talks about how the housing recovery has gained traction, and we've really, across the country, passed the bottom. Home resales are rising. Builders are building again. Property values are increasing. People have been saying for years that rental rates, that finance rates are not going to increase, and I totally agree with that. But the bottom has turned, and it's upwardly trending. And so if you've contemplated using retirement money or using money that you have in savings or money that you have in the market and switching it over to single-family homes, the time is really now. You know, my own personal goal this year is to personally buy, you know, as many homes as I can afford, as I can get my hands on. Now, let's talk about Indianapolis specifically, because I know some of you on this webinar already have property here. Some of you are considering, and you're wondering, you know, what's going on in the Indy market place. And let me show you a couple articles that have just come out in December. Here's one from the IBJ, which is the Indianapolis Business Journal, from December 17th. And it talks about how home sales in the Indianapolis area have been increasing 19 straight months. There's a lot of market activity out there for owner-occupied. So that's only going to go increase. Really, there is a pent-up demand for new construction. And builders are building as fast as they can, but they're not able to keep up with that. And actually, new construction is barely keeping up with population growth here in Indy. So, you know, I love the last paragraph. Prices, for the most part, are increasing due to a falling inventory of available homes. There were 11,000 existing homes on the market in November, a drop from 13,000 in November 2011. Okay, so the overall inventory is decreasing. You know, a couple of the big drivers here in the Indy market is motorsports. A lot of you have heard the expression that Indianapolis is the racing capital of the world. Now, there's about 1.8 million people here in Indy Metro, and this is from December 6th that talks about how motorsports sector contributes 23,000 jobs locally that pay an average of $63,000 a year. And this sector is indirectly responsible for 421,000 jobs. So racing and motorsports is a huge industry here in Indianapolis. And, you know, just think about the Indy 500 that brings in, you know, 400,000 fans a year. That's a big, and related to that directly is tourism. Tourism is huge here in Indianapolis. It's thriving. Here's an article from, let's see, what was the date on this? December 6th, okay? In 2011, tourism pulled in $4 billion here in Indianapolis. We have the new convention center. We have the revitalized downtown. And, tourism is directly responsible for 75,000 full-time jobs just in Indianapolis. Wages are increasing, and it generates $632 million in local and state taxes. Tourism is huge. Seminars, conferences, and are huge. And they added 2,000 new hotel rooms in Indianapolis for the Super Bowl, and they've been running at 90 to 95% occupancy rate. So, the Super Bowl was phenomenal in terms of waking up the world to what's happening in Indianapolis. Now, downtown has really been a focus, and those of you that have come out to the bus tour, have property here, know how great downtown is. And we've really turned some of our focus to apartments. This is an article that came out December 29th, how there's 7 current huge projects downtown that are being developed, and $500 million worth of projects. Now, they're currently building 1,600 units downtown. And I wanted to kind of outline some of the things that are on the agenda, because they really, a city really goes as its downtown leads. And the downtown in Indianapolis has just been phenomenal, whether it's putting the football stadium downtown, the new convention center, the JW Marriott, Simon Properties headquarters is downtown, Eli Lilly is downtown. And now, for the first time ever, they have this phenomenal push for housing and apartments. And this article talks about that. Now, there's the last section here. Let me show you this. A host of significant projects are on downtown's wish list, and several could start in 2013. A $17 million transit center for the Indigo bus system, redevelopment of the former Market Square Arena site just east of the City County building, more construction along the downtown canal, a possible city proposal to redevelop the Indianapolis Public Schools bus lot near the northern end of the downtown stretch of Mass Ave, a redesign of Monument Circle, a redevelopment of the Indianapolis Star Building, which is in the heart of downtown, a new use for the 100-acre General Motors stamping plant site that is no longer General Motors. And, there's some really big urban planning and urban projects that are taking place in addition to the $500 million in construction for apartment rental units. Now, when you look at unemployment in Indy, some of you may have seen this in the past, but let me show this to you real quick. I don't know if, I believe this was the September issue of Money Magazine, and it talked about how Carmel, Indiana, which is part of Indy Metro, was named America's best place to live. Some of the reasons for that is less than 4% unemployment, diverse tech and healthcare. When you really look at a job breakdown in Indianapolis, there is no one dominant industry. Tourism is huge. Motorsports is huge. There's 100,000 students at 4 universities in Indianapolis. And, all of those related university jobs. There's, obviously Eli Lilly and healthcare is huge. WellPoint, which owns Blue Cross Blue Shield, is the second largest healthcare provider in the country. And so there's a phenomenal diversity of jobs. When you combine that with the fact that Indianapolis is growing at a rate of 2,000 people a month are moving here. Now think about that. 2,000 a month. There's an annual growth rate we've had for the last 15 years, 1.5% a year. So, do the math. That calculates that's 2,000 people a month. And, they're moving here because of all the opportunity, because of the jobs, and because of the affordable housing. When you compare the median home price of, let's see if I have that slide here. I don't know if I have that. When you combine the median home price of about $100,000 with the median income of about $60,000, you have the most affordable housing in the country. A lot of people ask me why that is. Well, let me just bring up Google Maps here, and I will show you. Okay, so take a look at Indy Metro, and you'll notice one common trait. First of all, let me even scale out a little bit. No lake, no rivers, no mountains, no ocean. I'm kind of pointing out the obvious, but I'm also pointing out, look at all the green. The reason homes have stayed so affordable is as the population has continued to increase, they just continue to plow down another cornfield and build new housing developments. That's really all that's happened. And you can see that reflect on the map. And that's helped to preserve the affordability. So you combine the growth with the cheap housing and the low unemployment rate, the jobs, and you really have the perfect storm for investment opportunity. And that's why we are acquiring homes as fast as we can, and that's why investors that we've been working with have been buying these properties. Now, let me show you another interesting article, and this is a big trend in 2013 as well. Many of you have heard of shadow inventory. And this is just talking about the fact that everyone knows that banks have been either not foreclosing on properties that they have the right to foreclose on because people are in default, but the banks haven't started the foreclosure process, or they foreclose and they're holding inventory back because they don't want to flood the market. It's a very real dynamic. And this article talks about how in Indiana and nationally, banks are finally moving on those properties that have been in default 1 to 2 years. So you look at home seizures rose in 29 states. A lot of this, many of you have heard of the robo-signing litigation. Basically, attorney generals went to the big banks, Bank of America and Chase, and said, you're not following our state foreclosure laws, and you were having robo-signers basically sign off on all this paperwork. You're mass-producing foreclosure paperwork, and you can't do that. So there's litigation. Obviously, there's a big settlement. And now that that's settled, and now that the market has turned, Bank of America and Chase are saying, okay, you haven't paid for a year or two. That's cool. There was nothing we could have done with your house anyway. We've already wrote off the loss, but now we're coming after you and we're going to take the house. And that's exactly what this article is about, and that's a big national trend that's going to take place in 2013. The market has turned. It's going back up. That means you need to start buying. This is the time to buy. And if you look at Indianapolis, it's 10th in terms of these home seizures. And, obviously that's something that we're taking advantage of because we buy more foreclosure properties in Indy Metro than any other group that's out there right now. And nobody's buying the volume that we are, and certainly not in the markets that we focus on. Another huge trend for this year. Now, let me show a couple of you. This is the first contact you've had with us. If you look at this website, invest317.com, this is a great starting point to get more information about us. On here, we have links to property management companies, Ryan Mullen, who blogs for us. If you'd like a copy of my ebook or to come to our bus tour, we do a radio show every Saturday, and we upload the show to iTunes. You can link to it here and download the show and listen to it absolutely free. So there's a lot of really good content on this website. Another great website is Wholesale Houses, and that's wholesale-houses.com. There's a ton of content that we've put on here. It's a great starting point to get information on events that we're having and opportunities for you to engage with us and work with us. We are doing a bus tour every month this year, 2 days. We'd love to have you attend the bus tour if you haven't already. If you have attended and you have someone who you think would be interested in coming to our bus tour, we'd love for you to send them. We'd be happy to pay you a referral fee or a marketing fee for any properties that they buy from us. I see a few names on here of people that we've paid referral fees to and marketing fees to. Usually we'll pay you about 3% of the value of the home. And our best leads are word of mouth, and we really try to emphasize that. So Wholesale Houses is a great website. Let me take a step back even a little bit further, and so for those of you who haven't interacted with us before, I'll give you a little bit of background about myself. I started in Southern California back in 98, 99. And this is my first flip right here. It was a duplex that I bought for $100,000. Not much to look at, but when I got a check for $50,000 in profit a few months later, I was completely hooked on real estate. And from this property, I bought 2 more houses, and then a 7-plex, and then some mobile homes. And 4 years later, I had made over $1 million buying and selling property. I came to Indianapolis in 2004 to start buying, and we currently manage with our company, Alpine Property Management, over 700 properties. There's our team there, and we manage those properties for investors all over the country and actually all over the world. We do everything. We collect the rent, we fix the houses up, we rent them out, we take the maintenance calls, and we have deals that you can buy that are all fixed up and rented out. We also have deals that you can buy that are pre-rehab, that aren't actually rehabbed yet, and you can get a little better return by buying those properties. A couple of you who have asked me about financing. We do have 2 companies that are offering financing to our investors, and both companies would like the properties to be rehabbed and rented out for financing. One of the groups will do a 30-year mortgage. The other will do a 15-year mortgage. And what's cool about the financing that we have lined up for you is that it's completely non-recourse. Now, for those of you who don't know what non-recourse means, that means that you don't have to tie your credit and your social security number to the property. So if you own a house right now and you have a mortgage on that, or you have a car with a car payment or a credit card, and you stop making the payments, your credit card gets screwed. I mean, your credit gets screwed. A non-recourse loan means that you don't qualify. Your credit is not tied to the loan, only the property. And so this financing that we have available, which is 15-year and 30-year, because it's non-recourse, you pay a higher interest rate. The 30-year is 8%, and the 15-year is 9%. There's also fees associated with those loans. But I love that they're non-recourse because 2 other benefits of them. One, a lot of people say, how do you build your business credit? Well, this could be a perfect way. You start an LLC, you buy a property with a non-recourse loan in that LLC, and now you're starting to build credit because it's the LLC that owns that property, not the LLC and then tied to your credit as well. You can also use your retirement money. Now, I would say probably 75% of the properties that we sell right now are sold to investors who take retirement money that they have, they roll it over, and they buy homes from us in their retirement money. It's not a withdrawal. You're not borrowing against the money. You set up a self-directed IRA. That's something that we can show you how to do. That's something we'd love to sit down with you and walk you through. An interesting statistic I was reading today. Only 2% of all IRAs are self-directed, but almost 10% of all IRA money is held in self-directed IRAs. Now think about that. Only 2% of all IRAs are self-directed, but almost 10% of all the money out there in IRAs is in self-directed. Self-directed IRAs have been a trick, if you will, or a technique that the ultra-wealthy in this country have been utilizing since the 70s when IRA legislation was passed. This isn't a new thing, but they've been utilizing it aggressively for years. Think Mitt Romney, when he did his financial disclosures for president, he disclosed that he has $25 million in a self-directed IRA. That's in Forbes magazine in September, if you'd like to read the article. And so this isn't a new technique. It's just something that, a lot of you may have an IRA with a company like Fidelity or Merrill Lynch. And those companies would never have told you that you could roll over your IRA into a self-directed checkbook IRA or a self-directed IRA and buy real estate with it. Why? Because they can't make any money from it, so why would they tell you that? So that's a big trend that we have, and we have a lot of investors that come to our bus tour to learn about self-directed IRAs, and that's something we'd love to discuss with you. Many investors were able to help find money that they never even knew they had. Now think about having $100,000 in an IRA, and the potential that that could give you to buy 2, 3, or 4 properties. So we're excited about the financing, and that's something that we'd love to sit down and break down with you one-on-one. Same with the IRAs. If you are here locally, we do a meetup on the 3rd Wednesday of the month, so that'll be tomorrow at the Columbia Club. If you'd like to attend, we actually have a pretty good sized room, so we'd love to have you come meet up with us at Columbia Club. That's tomorrow night at 6:30. You can go to Invest317, or actually what I'll do is type my email in the chat bar, and you can shoot me an email, and we'll get you a spot reserved. So that's tomorrow night. We'd love to meet up with you. And we found that it's a fantastic networking event. Some really good relationships have resulted from the meetup that we do, and it's really been a cool thing. Now, not this weekend, but next weekend, the 27th, excuse me, 27th and 28th, or 26th and 27th. Let me double check. It is the 26th and 27th. We'll be doing our bus tour here in Indy. It's going to be at the Westin downtown, and if that's something that you would like to attend, we'd love to have you attend that as well. So more than anything, we wanted to use tonight as a chance to share with you the trends that we're seeing in 2013. Private equity will make a huge play this year. Private equity has historically been far ahead of the average consumer. So the best way that you can be competitive is to follow their lead. And they realize what a phenomenal opportunity single-family homes are right now. And whether it's with your retirement money or money that you have in savings or money that you have somewhere else, like in gold or the stock market, there's never been a better time to buy real estate than right now. That's a big trend. That's something that you should understand. Shadow inventory is a big trend. Another reason why you need to be investing in real estate right now. And financing is another potential big trend that we see on the horizon. So we scour the newspaper and articles that are out there every day. I have national contacts with, let me just show you the credentials of some of the partners that we work with. Okay, this is the group out of the Bay Area that we work with. Look at the pedigree. Okay, Lehman Brothers, Salomon Brothers, $60 billion in assets. Putnam Investments, Liberty Mutual. Okay, we're talking some of the brightest people in the country with deep backgrounds in real estate, and who have their finger on the pulse of the country. And so we would love to network with you, keep you in the loop on that, whether it's at a meetup, whether it's at these webinars, whether or not you work with us or not. Let me go ahead and show you one other video that we put together for a couple of you who haven't really had contact with our company. This Aplex has like meticulously rehabbed hardwood floors, and you can see the lead glass window in the front units and the slate roof on the fronts. They're really cool units. do it on 50 properties, Newton County Savings and Loan was taking those deals back. We've been doing this for 5, 6, 7, 8, 9, 10, 11. We're in our 8th year doing the same thing with the same business entity. And we've bought thousands of properties and managed for hundreds of investors. There is a phenomenal demand for Indianapolis properties, not just in the U.S., but all over the world. We found that that's really the case with real estate. We don't think that we have any secret sauce, and we certainly don't think that anything we specifically do is that unique. So, for example, when we screen tenants, we actually pull their credit. We actually call where they used to live before, say they used to live. We actually want to see pay stubs. You know, you'd be surprised at how many other companies take shortcuts from that. Why do we do that every time to every person? Because we found that when we don't, we end up evicting them. And so, you know, just the trial and error of that. So is that really unique and cool? No, it's not. But we never vary from that because we found that it works. But anyone on your team, you want them to have a skill set or a personality trait or a knowledge base that you lack. If you can't do that, then it's an ego issue, a pride issue, and you're going to suffer.
If you're coming up with a game plan to reduce your risk, what you need to look at is my risk different in Arizona than it is in Indiana? It's not.
Average, right? Our unemployment is consistently lower than the national average, and it's consistently lower than most places in the country.
We were packaging up bonds and selling them and doing all this stuff, right? And then here's the crash here in 2009, and then look, here we're bouncing back.
So what I want to talk to you guys about is the nuances of your relationship with your contractor, because some of you are going to go back to wherever you live and decide, I want to do buy and holds.
You think they might be currently playing a game right in front of your nose in your neighborhood, buying the house next to you, and you have no clue. Yet you're here to learn about real estate.
That neighborhood's wonderful. I'm going to get in and out and get that thing sold right away, so I'll up my percentage. So in this formula, what's our two most important things? Estimating sales price and estimating rehab costs, because again, the formula is, here's my sales price is $100,000, 75% is my target, so that's $75,000. My rehab, say $15,000, I'll pay $60,000 to meet that formula.